some opening comments.
Sure. Well, first of all, thank you, Jim, for hosting me. Thanks all of you for taking time. As Jim said, it's very important for me to hear from you. I like to level set. Some of you may have heard me say this before, but I like to say it wherever I go because a lot of people don't know a lot about the Federal Reserve. As you know, the Federal Reserve is our nation's central bank. One of the things that makes our central bank different is that our central bank is distributed all around the country. And that goes back literally to the founding of our country in American history. Our nation always hated the idea of having a central bank at all because it sounded very mysterious. No offense, a bunch of bankers in a dark room doing God knows what. It all sounds very undemocratic. So Alexander Hamilton created the first central bank for our nation. It lasted a few decades and they got rid of it. They said, we don't want that. But then in the 1800s, our economy was hammered with financial crises, the late 1800s, culminating in a really big one, the banking panic of 1907. And then Congress said, well, we need to do something about these big crises and these ebbs and flows. I guess we need a central bank. But if we're going to have one, we don't want it all concentrated in Washington, D.C. We want it to be distributed. So in a sense, there's a separation of powers. So you've all heard of Janet Yellen, the chair of the board of the Federal Reserve. She sits in Washington, D.C. with the governors. They're all appointed by the President of the United States, confirmed by the U.S. Senate. And then we have 12 regional Federal Reserve banks, including the Federal Reserve Bank of Minneapolis. And importantly, I was not appointed by either President Obama or President Trump. I was appointed by a local board of directors. And that local board of directors is here to represent all of you. And I'm here to represent all of you and my colleagues at the Minneapolis Fed. And so this separation of powers is really core to our economic system. And that's why I'm here. That's why it's so important for me to get out across our community. I was in South Dakota earlier this week and hear directly from you what's happening in your business, what's happening in your local economy, what's happening in the job market, so I can then take that information back to Washington, D.C. when we meet 8 times a year to set monetary policy for the nation. And that's why it's critical that I'm able to be out here with you and, importantly, hear directly from you. So thank you for that. With that level setting, let me turn it over to Jim, and we can start the Q&A, and then we'll turn it over to all of you.
Absolutely. Thank you for that introduction. You are a voting member on the FOMC, and in the last 2 rate hikes, you were the lone dissenter on the votes for those rate hikes. Can you give us a background on the information that guided you in that and some thoughts on current monetary policy?
Sure. A big surprise for all of us since the financial crisis. Well, unemployment peaked at around 10% nationally at the worst of the Great Recession. And the job market has gotten much stronger over the last 6 or 8 years, especially over the last few years. We're now at a national unemployment rate, official unemployment rate of 4.3%. The economy has been creating a lot of jobs, 180, 200,000 a month, which is much more than we need to keep up with population growth. Normally, we would have expected that strengthening job market to lead to strong wage growth as businesses compete for workers, which would then lead to inflation. But much to our surprise, over the last 5 or 6 years, inflation has been coming in lower than we would have expected, lower than we're targeting. We have a target of 2% inflation year over year. So my perspective on monetary policy has been, we keep undershooting our inflation target, wage growth is low, why do we need to cool the economy down when we're not seeing these pressures building? Yes, we're seeing the job market continues to strengthen, but if it's not leading to wage growth, strong wage growth, and then inflation, why slow things down? So that's basically been my perspective. Today, we got another inflation reading yet again today. The CPI came in again today. Again, it came in low. And so I'm not predicting high inflation or low inflation. I'm saying we have the luxury of waiting to see what actually happens. For 5 or 6 years, the Federal Reserve has been predicting inflation's about to take off, inflation's about to take off. For 5 or 6 years, we've been wrong. We have the luxury of waiting to see what actually happens. Why don't we just wait to see what actually happens before we then decide where to go with monetary policy? So that's why I've dissented. And thus far, the data, I think, has supported that perspective. We'll see where it goes from here.
Thank you. And again, if you think you'd like to ask a question, start to get ready for that. I'll ask one quick one before, and if somebody wants to get ready to ask the next one. As a voting member of the FOMC for the first time this year, and determining monetary policy. You're one of the few non-economists among Fed presidents. How do you feel about that? What's that been like for you?
You know, it's been fine. I'm very comfortable working with economists. We have brilliant economists at the Minneapolis Fed that I work with every day, and we bounce ideas back and forth. One of the things that's interesting about the economics field, which you probably have figured out, it's not an exact science, right? A lot of judgment goes in. We get a lot of data every day, and a lot of times that data is conflicting with each other. So it's hard to get a read of exactly where the economy is going. This is not like an engine or an integrated circuit where you pretty well understand exactly what's moving and what's causing what. So it ends up requiring a lot of judgment and experience to trade off these various signals that you're getting. And so I don't actually feel like I'm at a disadvantage. In some sense, I feel like being an engineer as opposed to being an economist is an advantage because I don't come in with a worldview that's been ingrained in me through graduate school saying this is the way the economy works. I come in saying, let's just look at the data and let's see what the signals are telling us and look at this from a risk management perspective. So I really enjoy working with economists. I learn a lot from them. I think the fact that I'm not an economist is a good thing because I think if you look around the FOMC table, you have 12 presidents and up to 7 governors if they're all full. I think it's good, healthy to have a mix of PhD economists and non-economists with a business background or an engineering background. I think that leads to better decision-making overall.
Absolutely. Thank you. I believe we have a question up front. While we run a mic over here, I'd like to remind you that, or ask you to please give your name and maybe your bank name or the company that you're with.
Thank you. Kurt Kovash with Kinetic Leasing. A couple questions related to your first comments. So what do you think are the big 2 drivers of why you guys are wrong on inflation? So what's affecting it? Why isn't it rising like you thought it would? And then if that's the case, and inflation's such a big driver of your decisions, why are they voting for rate increases, or why have they been?
Yep.
Why have you been the dissenting guy and everybody else is saying, let's raise them?
Sure, great questions. So first of all, I think the biggest factor, we're not exactly sure why inflation's been low, but one likely factor is that the headline unemployment rate only includes people who are actively looking for a job. If you have given up looking for a job, you're considered to be out of the labor force and you're not captured in that metric. Now, in most recent decades, that headline unemployment rate has been a pretty good proxy for the job market as a whole because there's always the same percentage of people who are not in the labor force. Well, when we had this hammering deep recession, a lot of people left the labor force and have not yet come back in. So we have to look at all of these different measures of the job market, the headline unemployment rate. You'll hear something talked about in the press called the U6 number, which includes people who are stuck in part-time jobs and are looking for would like full-time work. And then you've also got people who are just on the sidelines. So one of the things that we've seen over the past couple of years is people who did not consider themselves to be in the job market ended up re-entering the labor force as the economy got stronger. There still is, if you look at working age people, the percentage of working age people today in the labor force is lower than it was 10 years ago. So it seems like there's still a slug of unemployed folks who would be open to re-entering. And so I think that is part of it. So it's a long answer to, there's more slack in the labor market than that headline unemployment rate tells us. And so we think as the headline unemployment rate gets lower and we use up the slack, that's going to lead to wage increases, that's going to lead to inflation. It may well be that there's more slack than we think there is. I think that's the most important factor. And then second, why are my colleagues making different decisions? I think they're making different decisions because they're very worried about accelerating inflation. People are worried that if wages start to climb, if businesses have to compete with each other, you may not get gradual wage growth, you might all of a sudden get an acceleration in wages. I call this, and I mean this with no disrespect, I call this a ghost story. Meaning, I cannot prove to you that there's not a ghost underneath this table. I cannot prove it definitively. There may be, but there is no evidence that there's a ghost under this table. There is no evidence in any of the data that wages have this acceleration factor and are all of a sudden going to take off. And if you look back at prior cycles over the last 50 years, we've been studying them at the Minneapolis Fed, looking at inflation dynamics and wages. There's no evidence of this. All of a sudden, it just takes off, and there's this great nonlinearity. And so I think that's the difference in how we're looking at things. We have I'm getting very technical, and I apologize. We have a 2% inflation target. The European Central Bank has a 2% inflation ceiling. So the European Central Bank has said it's really bad if inflation ever crosses 2%. That's a choice they've made. We've said it's a target. So if we're at 1.5 or we're at 2.5, it's equally bad. So my perspective is we've been at around 1.5, 1.6, 1.7. If inflation starts to climb and we end up at 2.3 or 2.4 or 2.5, so what? So I think it's those relative trade-offs that we are debating each other in the meetings. Sorry, long answer to your question.
Great answer, though. I can't see back there. Is that Perry?
Good morning. My name is Perry Forrest. I'm a small community bank on Citizen State Bank, Norwood, Young America. My question is monetary policy that's been in place, it seems like the Fed is starting to talk about bubbles in the equity markets and that kind of thing. Do you feel there's a risk if we continue where we're at, the fact that people are willing to take on more risk to get a yield that's created some non-justifiable equity values?
So we do pay attention to asset prices across different asset classes, but there's a big difference in asset classes and what risks they pose to the economy. So you all know, as well as I do, how painful the housing downturn was for your businesses, for the U.S. economy in 08, 09, et cetera, and that very long recovery as a result of that. The reason that housing corrections are so painful for an economy is because the housing asset class is almost entirely funded by debt. 80%, 90%, 95% leverage. So if you have a minor asset class or asset price reduction, all of a sudden people and institutions are insolvent, and that leads to financial crises. In contrast, think about the tech bubble that blew up in 99, 2000, and then burst. That tech bubble bursting did not lead to an economic collapse for the U.S. economy. It led to a fairly minor recession. Investors lost money. Tech investors lost money, venture capitalists suffered, but that's a market economy, right? Those things happen. So from my perspective, and I think most of my colleagues would agree, we try to pay attention to, is an asset class correction likely going to lead to financial instability or not? A stock market correction, say 10% or 20%, I don't think is likely going to lead to a financial crisis because there's not nearly as much leverage under the stock market as there is under housing. If you go and margin your stock account, you can margin up 1-to-1. You can't margin up 10-to-1. And so there's just fundamentally less debt under the stock market, which I think means a correction is not going to be as problematic as a correction under a debt-financed asset class. So we do pay attention to these asset markets, but the analysis we're trying to make is not whether we think asset prices are going to adjust. It's what would happen if asset prices adjust, and that's where we try to focus our efforts.
I think we have one. Noah?
Good morning, President Kashkari.
Please call me Neel, Noah.
Okay, Neil. It was a little bit of a softball, but I think most people in the room know that you delivered a report at the end of last year regarding too big to fail. And I think there are at least a couple in here that attended the holding company outreach event that I was at yesterday at the Federal Reserve. And I wonder if you might just walk through the high level for those that have not read the plan.
Sure.
Because I thought it was a really nice outline at yesterday's event.
Thank you. So the financial crisis is burned into me from my experience during the 2006, 2009. And bailing out the banks was the right thing to do because we were having a massive heart attack as a U.S. economy and we were facing a Great Depression scenario. But we never, ever, ever want to have to do that again. And it was the right thing to do, but let's avoid it. How do we avoid it? We avoid it by making sure the biggest banks in America are no longer too big to fail. The fact of the matter is your institutions were not at risk of bringing down the U.S. economy. If your institutions failed, it would not be good for you or your customers or your communities, but you do not pose a systemic risk for the U.S. economy. The biggest banks in America are absolutely still too big to fail. Don't let anybody tell you otherwise. They absolutely are. And I don't think that's okay. I think we should do something about that. So The Minneapolis Fed spent all of 2016 consulting with the best experts in the world to hear their ideas on what to do about it. We came up with a draft plan at the end of the year, which we're still tweaking, and we'll put out a final version soon. But the bottom line is, for the biggest banks in America, so $250 billion and above, we basically need to double their equity capital requirements. That's, you all know, I bought a house a year and a half ago. The bank that I got a loan from made me put 20% down. What's that 20% for? That 20% is to protect the bank in case I run into trouble. Well, if we make the biggest banks in America fund themselves with 20+% equity, we can actually protect taxpayers from having to bail them out when they make mistakes in the future. And then the plan has other features such as making sure that all the activity doesn't just move from the biggest banks to the biggest hedge funds. So we level the playing field so the cost of funding is equalized between big hedge funds and big banks. And then importantly, we reduce the regulations on community banks, rationalize it, so that small and mid-sized banks are in a position to grow, to compete on a level playing field. And if some of that activity moves from the giant banks to lots of little banks, that's a good thing, right? The US economy will be safer and sounder, and we'll have a more democratic banking system. And so those are the very high-level points. The details are on our website. Happy to talk to you more about it. But the bottom line is, I want the American people to know, and members of Congress and state legislatures and governors to know, the biggest banks in America are still too big to fail. We can do something about it in a way that passes cost-benefit tests for our country. Now the question is, do we want to do something about it? And that's up to the public to decide.
Your work in that area has been very bold, and probably not everybody likes what you're doing from
True.
what I've at least read in the public, but we thank you for that. One key part of the plan is community bank regulatory relief. Can you touch on your thoughts regarding community bank regulatory relief and what makes sense as all these bankers are actively interested in your thoughts there?
Absolutely. Yeah. I'll give you a simplified version, and we're still fine-tuning some of this right now, so our final version will have more details. But you are subject to a lot of regulations that, in our judgment at the Minneapolis Fed, don't directly map to the safety and soundness of your institutions. We think we should keep the regulations that do directly affect safety and soundness, such as capitalization levels, but otherwise get out of the micromanagement business. We do know that it's much more costly for you to comply with certain regulations as a percentage of your cost base than it is for a giant bank. We do know that the regulations that have been imposed have made the too big to fail problem worse because it has given bigger advantages to the bigger institutions. It's forcing and driving consolidation in the industry. Those are not the outcomes that were intended when these regulations were designed. So let's keep the regulations that are legitimately tied to safety and soundness. Let's try to thin back some of the other regulations that are not. Let's rationalize it and put you on a level playing field. But we're going to have a lot more details on this coming out soon. I'll say this, you're not going to get everything you want, because then you just keep moving the line and you keep asking for more and more things. But we are trying to take a very honest look at what do we think actually leads to you to be more effective in your roles, and focus on that, and let's get out of the micromanagement.
Absolutely. I think we could take a... So for that to happen, you are being bold and you're taking a stand, and I think most of us in the room admire that. There would be a lot of people that would need to get on board: Congress, regulatory agencies, et cetera. How do you view that? Do we have a shot?
Well, it's tough. I'll say this: every time I go to Washington for a FOMC meeting, I take an extra day and I go up to Capitol Hill and visit with our elected representatives from our region and from around the country. Republicans and Democrats almost, not entirely, but almost unanimously agree with 2 points. We need to do something about too big to fail, and we need to rationalize regulations on community banks. There is strong bipartisan support on both of those. And those two are actually tightly linked, because a lot of some members are worried if we relax regulations on some banks, you're going to relax regulations on the biggest banks. And so some people are more focused on community banks. Some people are more focused on too big to fail. I actually think if you did them both at the same time, you could make everybody happy, You could say we're really going to address the too big to fail risk, and we're really going to rationalize regulations on community banks. So I've been pleasantly surprised how much everybody agrees with those 2 points. Now, coming to our political system, just because everybody agrees with something doesn't mean it's going to happen. And so I'm just trying to get out there and put the analysis out there in a non-political, non-partisan way, arm our elected leaders with the data, and then hopefully they will take it from there. But we'll see.
Thank you. I think we have one up front. Harry?
Harry Walk with Star Bank, Minnesota, President Kashkari. There's a third leg to that stool, and that is that a lot of us in this room are financing agriculture, and agriculture is our lifeblood. I think the growth of a farm credit system and its maneuvers and business acquiring days have really taken a toll on the small community banks. For example, we have been a participant with Farm Credit over the years on the guarantee program under FSA, but to have Farm Credit Services actually come out and cherry pick our best customers on huge loans that are prime rate customers for us and take them away from us as an earning asset is really hurting the small community banks to a great degree. As a matter of fact, we were a participant in the Small Business Lending Fund, which was the carryover from the days of TARP. And because we did not meet our loan growth objectives, which was part of that, we had to pay a fine to the to Treasury for not meeting those growth plans due to the fact that Farm Credit was refinancing loans that we had on our books to deviate from our growth goals. So it's a systemic problem with agricultural banks throughout the country. And I'm just wondering if there's something that the Federal Reserve Board could do to help us address that issue.
So the honest answer is I don't know. And I have not heard much about this when I traveled around. I'm not disagreeing with you, but I need to learn more about it. And so I appreciate you raising it to me, and I'll talk to my colleagues because I just don't know enough to give you a good answer right now. But I'd be happy to follow up with you when I do know more about it. And so maybe afterwards we can connect and I can get your contact info.
Perfect. Thank you.
Thank you for asking it.
You stumped him. There should be a prize for that, huh, Harry? We got.
There's in the back.
Is there? Okay,
Yeah.
great.
Good morning. Good morning. My name is Ben Askirka. I'm from United Bankers Bank in Bloomington, Minnesota, and I work for all of these community banks that are in this room today. I'd like to thank you for being here and for the opportunity to ask a question. And before I ask that question, though, I would encourage you to continue to be a supporter and an advocate for community banks, not only in Minnesota, but throughout your district. They really would appreciate your help. My question relates to something that has puzzled me for some time, and I'd like to get your thoughts about the direction and the trajectory and the velocity of money, which, as you know, has been trending lower, is at all-time lows, not showing any signs of turning around, even with the pickup in economic activity. And my question is, do you feel it's still a good indicator of economic activity? And if not, why? And if so, what is it saying about the current state of our economy?
Well, to me, it's related to investment, meaning, for example, the Fed has ballooned its balance sheet, which people are well aware of, to around $4.5 trillion, but we also have all of these excess reserves in the banking industry. And many banks are choosing, in a sense, to invest in these excess reserves rather than putting that money to work elsewhere. And so what's driving that? A big question we have is why has investment in the U.S. economy been relatively slow? You would think with very low borrowing costs that it'd be a very attractive opportunity for businesses to go and invest. And investment has not been as strong as we would like to see or would have expected. And you're also seeing firms, especially public companies, buying back their stock rather than in making fundamental new investments. And so to me, the question is related to that is why has investment been low and why aren't businesses investing more and putting all of the excess cash that's out there, putting that to work in the real economy? And this is closely related to a conundrum that the economics profession is facing, which is why has productivity growth been low? And the question is, for the last several decades, productivity growth was about double what it's been in the last decade. productivity growth is enormously important to our future economic growth and our wealth and our livelihoods and our well-being. There are some theories out there. Maybe the things that we are innovating today as a society are not that important, not that impactful. I'll give you an example. So there's been big breakthroughs in social media over the last decade. Seems really exciting, seems really sexy. Well, if you compare it to the innovations of 100 years ago, the internal combustion engine, the airplane, the integrated circuit, 75 or however many years ago, it's not that impressive, right? I mean, compared to the airplane, Twitter, give me a break. I'm not even sure if Twitter and Facebook are net productivity enhancing at all, right? In some sense, we communicate with each other more quickly, but how much time is also wasted on social media programs as well. So there are these big fundamental questions about, are the innovations that we're making in technology, are those really moving the needle, and are those providing businesses attractive new places to invest, to expand, and to make more money? So all of these things in my mind are related to why is our economy growing much more slowly than it has been in the past. I mentioned that productivity growth is a huge source of future wealth for a society. Another source of economic growth is just population growth. And our population is growing much more slowly than it has in the past. The reason is we're having fewer babies than we had in the past. And in the 70s, 80s, and 90s, our economy really benefited when women moved into the workforce. They moved in a huge wave, which was great. It was a big boost to labor and production. Well, women are now already in the workforce. So there's no one-time gain to be had that we had over the last several decades. And so all of these things are related to each other. And these are tough policy challenges for us. But ultimately, to me, they're related to where are people choosing to invest, how much are they choosing to invest, why are they buying back their stock rather than making these long-term fundamental investments that we would like them to see. So I wish I had a perfect answer for you, but these are things that we are trying to understand and we're paying a lot of attention to. Well, in some cases there are. So the gentleman asked as a follow-up, are they hoarding cash? You certainly do see some of the most, like why does Apple have tens of billions of dollars of cash on their balance sheet? Why are some of these giant tech companies that have billions and billions and billions of dollars on their balance sheet also turning to the debt markets to raise more cash and then choosing to buy back their stock? You know, there are not easy answers to these questions.
Thank you. Great question, Ben.
Yeah, Bob Meyerson, Harvest Bank, Kimball. Used to be that the printing of money, of currency, was the prerogative of the government. Now we're seeing the emergence of other kinds of values. Bitcoin, when banks get hacked, the criminals demand payment in Bitcoin to release the hack. And of course, this also has implications for the Fed's control of the money supply. How will the Fed or the government regain control of this and perhaps diminish the ability of the criminals to prosper?
Well, there's a lot in your question. We're paying, I think, across the Federal Reserve System, a lot of people are paying a lot of attention to these virtual currencies, such as Bitcoin, et cetera. The criminal fraud activity, let's separate that for a second. That's enormously important, and we need to prosecute thieves and fraudsters with the full weight of the U.S. government and the Justice Department, because whether somebody converts fraud to profit or theft to profit using Bitcoin or dollars, it's still fraud, it's still theft, they still need to be prosecuted either way. In terms of things like Bitcoin and virtual currencies, I'm not that worried about the dollar as finding a competing alternative. I'll tell you why. The biggest selling point that the proponents of Bitcoin said when they founded it was that you guaranteed there would be no runaway inflation, because you knew at the start there'd be this many Bitcoins ever produced over history. That was perfectly controlled. There was no risk of inflation. That may well be true, but the barriers to entry of creating a new virtual currency are very low. So you may have Bitcoin, I'll have Neel coin, he'll have Jim coin. If you look at the early part of our nation's history, every state had its own currency. So even if you had confidence that Virginia was not going to have runaway inflation, if New York had inflation and Massachusetts had printing and New Jersey and South Carolina, you still had inflation. And so I have not seen a solution yet to the very low barriers to entry for people creating alternatives, altcoins. And that to me is a fundamental weakness that, where do central banks get their power? We are provided a monopoly by the government as the only person allowed to create this currency. So the Congress gave the Federal Reserve that power. Europe gave that power to the European Central Bank, et cetera. And that's where the real power of these central banks comes from. So we're paying attention. We'll see what happens with the virtual currencies. As of right now, I don't see them as realistic competitors to the dollar.
Thank you. Looks like we have one in back.
Yes, hi, this is Francis Marino from the Baker Group. You'd mentioned that in the last run of quantitative easing that the balance sheet swelled. Buying stopped in 2014, but Mrs. Yellen said that relatively soon you would be looking to unwind the balance sheet some. Do you still think that's on track? And if so, how do you think that might affect the markets?
I do still think that's on track. I think there's a lot of agreement across the Federal Reserve that we want to normalize the balance sheet. It probably won't be as small as it was before the crisis, but back to a more normal level. In June, we put out some details on exactly how we're going to allow that roll-off to take place. In very short summary, we're not planning to sell the portfolio. We're planning, as bonds mature, both treasuries and mortgage-backed securities, simply to let them roll off as they mature under the ordinary course, subject to certain caps. So we will gradually shrink the balance sheet over time. I think that under Chair Yellen's leadership, I think the Fed has done a very good job of forecasting to markets exactly how that's going to take place. So there are going to be no surprises, and we will allow that unwind to happen. These are the types of things where if the markets see it coming, if the markets know it's coming, they know how it's going to come, it probably is not going to lead to any type of market disruption. That certainly is our goal. We're doing everything we can to minimize surprises to the markets, and I think so far, knock on wood, I think we've done a pretty good job of that. So I would anticipate that we're on track. I would not anticipate that there's going to be a big disruption in the markets.
Thank you. Others? Yeah, please stand up or raise your hand. Yep, it's hard to see from up here.
Hello, Dennis Martinson, Glenwood State Bank. One of the comments has been, why have we had the slow economic growth during this time of low interest rates? We've talked about the high income tax that keeps us from developing and moving forward with our economy. But there's another tax also, and it's the real estate tax. Not all states have it like Minnesota does. We have a real estate tax that's also for the general fund. And that real estate tax for the general fund is about a third of the total real estate taxes that we pay on property. And the real estate taxes are an amount that in many cases equals the total interest that's paid on loans for development. So this is another of those taxes that keep our development from growing as it should. And I'm just wondering if you have looked at the effect of real estate taxes also on development.
So I have not, but I understand your point, and I think what you said makes sense. We have to separate monetary policy from fiscal policy. So Congress has given the Fed the charge of monetary policy, adjusting interest rates to achieve our dual mandate of stable prices and maximum employment. Fiscal policy, how much the government wants to collect from all of us in taxes, and what activities are taxed, and where that money is spent. That's purely the domain of fiscal policy, so Congress and the executive branch. So very aware of what you're saying, but I would say that is out of the purview of the Federal Reserve. More broadly looking at taxes, I think most economists would agree tax reform is a good thing. So, people can debate what level of taxation you want overall, but generally speaking, taxes that are broader, where you're not cherry picking certain industries, certain activities, lead to fewer distortions in economic activity, lead to long-term more economic competitiveness and better economic outcomes. So that's, I think, the limit of what I would say about our tax system. Broader taxes, fewer loopholes, fewer deductions, even playing field probably will lead to a more competitive economy. But in terms of the overall level of taxation, that really is a discussion for the public and their elected representatives to decide. but I'm not disputing the point that you're making at all. I will say, as it relates to real estate, sorry, one more point, is we do hear, one of the things I hear when I travel all around our district is the lack of affordable housing. Everywhere I go, I hear this, and I'm always scratching my head wondering, why is this an issue everywhere? One of the things I've concluded, if wages go up, that doesn't solve affordable housing. Because if everybody's wages goes up, everybody can afford more, and home prices are going to go up, and there's still going to be an affordable housing issue. One of the things I've realized is that everywhere you travel, there are a lot of local regulations that are barriers to new development, barriers to new supply moving in. That, to me, is a big policy challenge that we need to wrestle with as a community so that more supply can come in and provide the housing units that people need. I know that's not what you were asking about, but that is something that I hear everywhere that I travel around our region.
And I'm sorry, they're doing some work somewhere. We can certainly hear it up here. I hope it's not interfering with what you can hear out there, and if anybody can do anything about whatever they're doing below us or behind us, that would be great. But along those same lines, but shifting gears a little bit, this year the Minneapolis Fed launched the Opportunity and Inclusive Growth Institute. Why do you see this as a priority for the Fed, and what do you think the Fed can do to address inclusive growth?
One of the surprises I found in moving to this region, Minnesota has a lot going for it, a very diverse economy. Most major sectors of the U.S. economy are represented here. Overall, a highly educated workforce. Overall, good schools on average. If you look, I think our schools are ranked 6th or 7th in the nation. So a lot to be proud of. But I was surprised at the extent of the disparities in the state of Minnesota and around our region. We have racial disparities. We have rural and urban disparities as well. As I started asking questions about why these disparities exist, what are the root causes, I found very few good answers, good explanations. So we decided to do something about it. We're not going to solve it on our own, but we're going to do research to try to unravel what are the root causes of these disparities and see if there are policy solutions that we could advocate that could make a difference. So I'll give you an example. Before I joined the Minneapolis Fed did a lot of work on the return to taxpayers of early childhood education. The economists at the Minneapolis Fed concluded that a dollar invested in early childhood education actually paid itself back many times over the life of that child or that family, and it was a net positive investment for taxpayers. Now, to the gentleman's earlier question about taxes, the Fed doesn't control taxes. But if we can do the analysis that says, hey, in a nonpartisan way, this is what the raw analysis shows us, we can put those findings in the public, and then maybe other policymakers, such as the legislature, could take it on. And I think the state of Minnesota has largely gotten behind early childhood education as a good investment. So we're looking for other types of analyses that we can do, may not be under the domain of monetary policy, but if our research can shed some light on it, we feel like that's an important contribution we can make.
Thank you. Who's next?
I asked you a question earlier.
Sure.
I don't know if you answered this or not, but is there an asset class right now that you guys are concerned about that has risk to the overall economy if something, were to blow up in it? And I look at, is it like fintech, with some of all the working capital that they're putting out there to higher risk borrowers and in that asset class as an example?
I mean, nothing immediately jumps to mind. Certainly, I used the example of the tech bubble. When the tech bubble burst, there was economic harm caused by that. We did have a recession following that. So if any number of asset classes suffered a major correction, could it lead to a recession? I think the answer is, very possibly it could. But does that mean that the Fed should step in to do something about it in advance? That's the tough one. In 1996, the chairman of the Fed, Alan Greenspan, called irrational exuberance in the stock market. He said, effectively, the stock market is overvalued in 1996. And then the stock market continued rallying for the next 4 years until it ultimately suffered a correction. Well, imagine if Greenspan had really tried to do something about it in 1996. Imagine if he said, I'm so convinced that we have a stock market bubble in 1996, I'm going to jack up interest rates until I get that bubble under control. That may well have inflicted much more harm to the economy than the actual bubble bursting did in 2000. And that's why I think we have to be very cautious as we look at these different asset classes, not about us paying attention to it, but about when we would choose to try to use monetary policy to do something about it. Because it may well be the medicine does more damage than the actual correction would do. So it's not a direct answer to your question. There's nothing on the horizon that's flashing red to me saying this is something that we're deeply concerned about. But the fact of the matter is, if something triggered a housing correction, that would lead to economic harm. If there was a major stock market correction, that could lead to some economic harm. Our primary focus is what's going to lead to some type of financial crisis. If we thought it would lead to a financial crisis, then I think our risk-return assessment would be different than if it would just lead to a minor economic contraction.
Thank you. Looks like we're heading over with
Here in the front.
prior to Lon.
Lon Rylander, First State Bank of Ashby, probably in the top 5 of the smallest banks in this room, 35 million in assets. My question is, you'd made well, it's maybe not a question as much as it is a comment. Fraud is fraud, theft is theft, crime is a crime. For whatever reason, Wells Fargo popped into my mind. And I guess I was just wondering if the FMOC committee or you and your colleagues get a chance to discuss any of that, if you'd like to share some of your thoughts on that subject of Wells Fargo.
Well, it's
Hot potato.
hot potato. I'll just say what I've said publicly in the past. I mean, I'm not in a position to comment on specific regulatory matters of a specific institution. We all need to hold one another to high standards. And if people fail to meet those standards, they need to be held accountable. So ultimately, the bank supervision is governed by policies at the Board of Governors in Washington, D.C., but obviously we at the Minneapolis Fed get very involved in the banks that we supervise in collaboration with them. And so I think what we all saw happening in Wells Fargo is totally unacceptable. And there have been some changes at the top. I just read in the paper today that there may be some changes in the board of directors. I think major changes when things like that happen are certainly appropriate, and we need to hold people accountable for their actions. I don't have more to say to it than that. Stepping away from Wells Fargo, one of my frustrations coming out of the financial crisis, I am frustrated that it seemed like very few people were prosecuted as a result of some very bad activity during the financial crisis. Now, for me, the root cause of the financial crisis, fraud was part of it, but it was not just fraud. It was also, we all participated in a nationwide delusion that home prices only go up. Human societies, if you look at human history, human societies are prone to mass delusion events. It happens time after time after time when people just believe something that proves not to be true. And in our society, it's not illegal to be stupid, right? We were stupid. I bought a house in California in 2005. That was stupid. It was not illegal, okay? So how do you separate stupidity? Sometimes it's hard to separate stupidity from malfeasance. And clearly there was fraud in the financial crisis. I wish more people had been prosecuted that had committed the fraud, but I also recognize it was collective stupidity. And my view is we are going to be stupid again in the future. So let's make sure our banking system is resilient enough to withstand that stupidity and not require a taxpayer bailout.
Excellent. Before we get to the next one, I've heard you say something along the lines of, math is math. And as a nation, we've been deficit spending for a long time. Our national debt is significant. What are your views on the national debt, the overall impact on our economy? And maybe ultimately, what do you think will force us to address it as a nation?
Well, this is an enormously important long-term issue for our nation. And this goes back to, I talked about the fact that we're not having kids at the rate that we used to. You all know this, our society is aging. Most of our entitlement programs are funded by current workers paying for current retirees. And as that ratio goes down, those programs go into the red. So then we just have to these are political choices, right? You've got levers you can pull to balance these programs. You can raise taxes, you can cut benefits, You can index them to retirement. You can index the retirement age to lifespan. There are a bunch of known levers that we have that can balance these programs. The tough part is getting everybody to agree on which levers to pull. So long term, we have no choice. In the end of the day, we can fight all we want with each other, but at the end of the day, math wins. There's no new math that makes these programs balance. In the end of the day, math wins. So somehow we have to reach political consensus and find courage to tackle these issues before there's a crisis. Now, the best thing we have going for us right now is the rest of the world has their problems too. So right now, the US is still the best, safest place for investors to put their capital. And that's because Europe has its whole host of problems. But imagine if Europe gets its act together, addresses the issues of the different growth rates of the different economies, and the issues that Greece has had, and Italy, et cetera. All of a sudden, maybe Europe will be a more attractive place for investors to invest. Then all of a sudden, our window to address our problems shortens or closes. So this is a political challenge, and I don't know how. Our democracy is really, really good at responding to a crisis. We did it. It was messy, but we did it brilliantly in 2008. Republicans and Democrats came together in record time in 2008, but it took a crisis to motivate that. In our fiscal situation, we need to reach agreement long before there's a crisis so we maintain our economic competitiveness.
Thank you. Tom.
I'm Tom Mork with Lakeview Bank down in Lakeville. I'm curious on your perspective of what an evolving immigration policy might have on the future of economic growth, not only nationally, but in the 9th Federal Reserve District particularly.
Well, I talked about the demographic trends, and our population is not growing the way it used to. Immigration is also part of that. A huge competitive advantage the U.S. has over almost every other country is that immigrants actually want to come here. I'm the son of immigrants. My parents came here from India. I'm married to an immigrant. Our competition for immigrant workers is basically Canada and the United Kingdom. They really don't want to go to Germany. They don't want to go to China. They don't want to go to India. They want to come basically to these three nations, and a little bit Australia too, basically because we welcome immigrants and we integrate them in our society, and they feel welcome, they can have a good opportunity for their families, et cetera. And by the way, I'm living proof of it, right? The son of immigrants getting to have the kind of role that I've had, this is a truly great country. If our immigration rate slows, our economic growth is going to slow. That is math. And so I go around the 9th District and I say, well, you have three choices. Literally, you have three choices. You can either accept slower growth, number one. Number two, you can spend taxpayer money to subsidize fertility. And that means child care, tax credits, et cetera. It's quite expensive. Or number three, you can embrace immigration. And you get to decide which of those three you want. But that literally is the math. And so we as a nation have to decide, do we want slower growth? Do we want to spend money to subsidize domestic fertility? Or do we want to embrace immigration? That's math. Because you intuitively know more population growth means more people to eat food from farmers, to buy cars, to buy homes, to get loans from your community banks. More people means more economic growth.
Great question. Thank you for that. Others, we have a little time left. Jack, up front here.
Has the, Jack Richter from Winona National Bank, has the Minneapolis Fed conducted, or does it plan to conduct, any sort of economic study on the impact of student loan debt and its impact relative to household formation and the housing markets and all those other pieces that seem to go along with that, because it's kind of a choosing, it seems to be, to me, and what its impacts are.
Yeah. Well, student loan debt is an enormously important issue. I don't think our bank specifically has done research on it, though, if I'm not mistaken, I think I've seen research around the Federal Reserve System looking at it. We do pay attention to it. It is enormously important. I mean, especially going back to, this is related to a lot of other things we've been talking about today. So if you think of, go back to productivity growth and my comments there, technology development is a big source of productivity growth, but skill development of our workforce is also a big factor in productivity growth. And in the economy that we are in, skill development is ever more important, and that's just going to continue. And so making sure that our population, our young people, are able to get the skills that they need to feed our businesses, to provide for themselves, to then fund the retirements of other generations is never been more important, and it's only going to become more and more important. And so it can't simply be that people have to take on more and more and more and more debt to make that happen. You know, basic supply and demand. When you increase demand for something, the price is going to go up. So the cost of college education has gone up. Students have had to fund that with their own student loans. So I do see a lot of universities are trying to look at different models of education delivery to try to reach more students at lower costs. We need to be really open-minded about that. So that's a long answer to say it's an enormously important problem. I don't think our bank has done a lot of work on it yet, but we are paying attention to it. And you're right, it does have implications for many of the other important topics that we've been talking about today.
Thank you. Another great question. We have time for a couple more. Any other brave souls?
We stumped them.
Really? Yes, I'm sorry.
Hi, Patrick Larson with Advanced Capital Group. You talked about the shrinkage of the balance sheet and said it was going to be gradual. I think that'll actually be strengthening to the financial system versus additional rate hikes potentially. But can you talk about some of the challenges that you see that could come from the unprecedented unwind of the balance sheet?
What are some of the challenges that could come from when the Federal Reserve unwinds the balance sheet? I mean, the biggest, if you would expect to see, as the Fed unwinds the balance sheet, you would expect to see long-term rates start to climb. So let me go back up for a second and explain why did the Fed increase the balance sheet in the first place? Because then we can talk about what the implications might be of the unwind. Once we said, the way we traditionally affect monetary policy is short-term rates, overnight rates. Now, you know as bankers that your borrowers don't really care what the overnight rate is. They care what their rate is going to be over the 7 years or 10 years that they have a loan. So the way we really affect the economy is we adjust short-term rates, and then that tends to have an effect on long-term rates, and then that affects economic activity. Well, once the Fed brought short-term rates to zero, were we out of ammunition? The answer was no. Then the Fed started buying long-term bonds to drive down those long-term rates directly to then make it cheaper for your borrowers to go get loans to buy a house or to expand their business. So now as we unwind the balance sheet, we would expect to see long-term rates start to give back some of that reduction in yield that we benefit or that we saw as a result. So one implication we would expect to see is that long-term rates start to go up, and then that would steepen the yield curve. Now, I think most bankers would say that's better for banks if the yield curve is steeper rather than flatter. But sometimes these things behave in unpredictable ways, right? The Fed has been raising short-term rates, and we haven't been seeing the long-term rates move as much as we would have thought. And so there's also this concept of a global savings glut. Investors all around the world are looking for safe places to invest their money. Maybe the long-term rates aren't going to move the way that we expect them to. And so I think that, again, we've done a good job of trying to mitigate the risks of this unwind, but sometimes the economy behaves in ways that we aren't completely expecting because there are global forces all interacting with each other. That, to me, is I think what I'm trying to pay most attention to. We're being so careful in how we do this. I don't think we're going to break anything, but it's still possible that global events could overtake our best laid plans.
Well, thank you. I can't believe how fast an hour passes when you're talking about really interesting stuff like this, right? We all love this, huh? It's our livelihood. So in closing, and before I give you a chance to give your parting thoughts, I just want to say on behalf of the Independent Community Bankers of Minnesota, we certainly appreciate you being here with us today. I feel like I can speak on behalf of the group, and we appreciate the leadership that you're providing at the Minneapolis Fed. We're glad to have you in this wonderful state, and we think that what you're doing as you balance the multiple constituencies that you have to worry about and think about. I think you're doing a really good job of navigating that, and I admire your leadership. So thank you for all you're doing there. And with that, I'll let you have the last word if you'd like.
Well, sure. Well, just thank you, Jim, and thank everybody for inviting me today and for sharing your thoughts and comments. And we're trying to do everything we can to be transparent to the public, to engage with the public in an honest manner. One of the things I try not to do is I try not to make predictions about where interest rates are going, because I think that just adds noise and volatility, which I don't think is productive. but I'm happy to talk about these things, in a backward-looking sense. And so I appreciate the discussion, and stay in touch. If you see things that you think we should see, reach out to us, and I want to hear it. You can reach out, through Jim, or you can email me directly, or reach out to folks at the Minneapolis Fed through our regulatory department. But we want to be engaged with you. You all are on the front lines. The more insight you share with us, the better we're going to be in our roles. And so we appreciate your feedback. So thank you very much.
Thank you.